Welcome to Countdowners. I am Nida here. In today's class, we will be covering the topic rules of accounting in traditional and modern approach. Accounting rules work as a base for any accounting framework. In my first video, I had explained the accounting principles and I hope you all watched it. Before applying those accounting principles, you are required to know the basic accounting rules that in a business transaction, which account should be debited and which account should be credited. Now, let's see how do the rules work in traditional approach. Traditionally, accounting rules are considered as the golden rules. Do you know why the traditional approach is called golden rules? Because there is a proverb or phrase which we all know that old is gold. This means whatever is old is as important as gold. We should not think or brand anything old as a waste. Even though something is old, it is still have high quality. In the same way, traditional approach is old but actually valued as gold. That's why traditional approach rules are called as golden rules. This is the traditional classification of accounts. Accounts are classified into two, personal and impersonal accounts. The names itself you all can understand what does it means. Personal accounts means the accounts related to persons. And impersonal accounts are the accounts not related to persons. Personal accounts are subdivided into three: natural, artificial, and representative. Impersonal accounts are subdivided into two: real and nominal account. Real account again subdivided into two: tangible and intangible accounts. We are going to discuss personal account in a detailed way. As I mentioned earlier, personal account related to the persons involved in the business. It is classified into three. First classification is a natural personal account. It is the human beings. So we include the accounts belonging them under this head. Accounts under this head are capital account. What is capital account? It means the amount invested by the businessman to the business. Drawing account. Drawing account is the amount withdrawn by the businessman from the business in the form of cash or goods. Debtors account. It means someone owes money to the business. Creditors account. Creditors account are someone to whom the business owe money. Also, persons are involved in the business. So, all these accounts are come under natural personal account. Second classification is artificial personal account. Under this head, artificial persons involved in the business, which means does not have physical existence like individuals. It is the legal and it is created by the human beings to involve in the business. However, in business dealings, they are recognized as persons. Examples are bank, charitable institutions, any public or private companies. These are all legal entities created by individuals but artificial persons. That's why all are come under artificial personal account. Third classification is representative. These are the accounts which represent a person or group. It is not directly goes to the person's account but linked or represented to them. All outstanding and prepaid items are come under representative personal account. Outstanding expenses. These are those expenses which have been incurred during the current accounting period and are due to be paid, but the payment is not made. Example, outstanding salary, outstanding rent, etc. Outstanding incomes means amount of income which is due and receivable but not yet received. Example, outstanding commission. The next item is, or the next account is prepaid expenses account. Prepaid expenses are those expenses which have not been recorded by a company as an expense but have been paid in advance. Simply, it is the future expenses that have been paid in advance. For example, prepaid rent, prepaid insurance, etc. Then what is deferred income? Deferred income is that the income received but not yet earned. Means pre-received rent. Rules of personal accounts are debit the receiver and credit the giver. This means if a person receives something, receiver account should be debited. And if a person gives something, giver's account should be credited. This rule is applicable to all three subdivisions of personal account. I will discuss the transactions once completing the explanation of all the rules of other accounts, so that only you can understand effortlessly. Keep watching till the end. Now it's the time to talk about impersonal account. It is the account not related to persons. Subdivisions are real and nominal account. Real accounts are the accounts related to all assets. It is subdivided into two. First one, tangible real account. Any properties or possessions which can be seen and touchable, that means there is physical existence of asset under this head. Examples of a tangible real account are all fixed assets like land and building, premises, furniture, plant and machinery, etc. and all current assets like cash, accounts receivable, accounts payable, stock, etc. Second one is intangible real account. Any properties or possessions which cannot be seen and touchable. That is intangible real account. There is no physical existence. Examples of intangible assets are goodwill, patent, copyright, etc. Rules of real account is debit what comes in and credit what goes out. If something comes into the business, it should be debited, and if something goes out of the business, it should be credited. Another classification is nominal account. These accounts which relate to all expenses, losses, revenue and gains. It is just like a profit and loss account where we use it to record the above mentioned items. Examples are all the expenses like purchases, salaries, rent, advertisement, wages, bad debt, etc. and all the incomes like sales, discount received, commission received, rent received, purchases returned, etc. Rules of nominal account is debit all expenses and losses, credit all incomes and gains. Here some points to remember. Purchases and sales are treated as a nominal account as those are main expenses and revenue of the business respectively. But purchase and purchase return, sales and sales return may or can be treated as real account as both are related to goods. If we do consider these items in both accounts are correct only. Let's do some examples. Cash is deposited in the bank amounting 5,000 dirhams. Here we have two accounts, bank account and a cash account. Bank account, we already know that bank account is an artificial personal account. So we have to apply the personal account rule. What is the personal account rule? Debit the receiver and credit the giver. Here bank receives the cash from the business. So bank is the receiver. So we have to debit bank account. And the next account is cash account. Cash account is a real account. So we have to apply the real account rule. What is the real account rule? Debit what comes in and credit what goes out. Here cash goes out of the business, so cash account we have to credit it. The entry will be bank account debtor to cash account. Next transaction is paid electricity charges 250 dirhams. What are the two accounts here? Electricity charges account and cash account. Electricity charges are the expenses account. So we have to apply nominal account rule here. What is the nominal account rule? Debit all expenses and losses and credit all incomes and gains. Here expenses. So we have to debit it. Electricity charges is a debit. Cash account, cash goes out of the business. So it's a real account. So we have to apply the real account rule here. What is the rule of real account? Debit what comes in and credit what goes out. So here cash goes out of the business, so we have to credit it. So the entry would be electricity charges account debtor to cash account. In modern approach, accounts are classified into 6. First one, asset. Assets are material things or possessions or properties of the business, including the amounts due to it from others. Examples are land, building, plant and machinery, furniture, vehicles, stock, cash, etc. Next one, expenses. Expenses means the cost incurred by a business in the process of earning revenues. So the expenses are measured in terms of services used. For example, rent, wages, salaries, advertisement expense, etc. The next one, drawings. Drawings, I explained earlier, it is the amount of cash or other assets withdrawn by the owner for his personal purpose. Next is a revenue or income. It represents the amount the business earns by selling its product or providing services to its customers. These are of recurring in nature, and sales is the major revenue of the business. Next one is liabilities. Liabilities are the amounts which a business owes to others, either for money borrowed or for goods and assets purchased on credit or for services rented. Thus, liabilities are claims of outsiders against the business, and it is also called creditors' equity. The last classification is capital. Capital also I explained earlier. Capital refers to the money or money's worth introduced or invested by the owner into the business. It is also called owner's equity. As per the modern approach, debit when asset, expenses and drawings increases and credit when it decreases. Also, debit when income, liabilities and capital decreases and credit when it increases. Now let's see some of the business transactions. Bought machinery for 1,500 dirhams by cash. Here you can see two accounts, machinery account and cash account. Both accounts are asset accounts. What is the rule for asset? When asset increases, debit, asset decreases, credit. Here machinery, when we are buying the machinery that asset increases. So machinery account we have to debit it. When we are paying cash for the machinery, the asset decreases, cash is reduced, cash asset decreases. So we have to credit it. So the entry will come machinery account debtor to cash account. Next transaction is paid salaries 800 dirhams by cash. The two accounts are salary account and cash account. Salary account is an expense account. Cash account is an asset account. So what is the rule? Expense account, when expense increases, we have to debit it. Here salary is an expense and it increases. So salary account need to debit. And when we are paying salary to the staff, that cash is reduced. So that asset is decreases. What is the rule for asset decrease? We have to credit it. So the journal entry will be salary account debtor to cash account. The next transaction is John started business with cash 20,000 dirhams. The two accounts are John's capital account and cash account. What is the rule of a capital account? When capital decreases, we have to debit it. Capital increases, we have to credit it. Here, John started the business with cash. He brought the cash to the business, so capital increases. So when capital increases, the rule is we need to credit it. So capital account here is a credit, and cash account, when John brought the cash to the business, cash asset is increases. So here cash account is debited. The entry would be cash account debtor to capital account. The next transaction is John withdrawn amount of 5,000 dirhams. Two accounts are the drawing account and cash account. What is the rule for drawing account? When drawing account increases, debit. So here when John withdrawn the amount, so drawing account increases, so we have to debit it. Cash account, cash is reduced, the asset decreases, so cash account is credited. So the entry would be drawing account debtor to cash account.